Let me ask you something. Have you ever seen headlines like, "Market crashes, stocks are soaring, investors panic," and you wonder, what exactly is this market? Is it a building? A website? A group of rich people pressing buttons? Today, I want to explain what the stock market really is, not with complicated financial language, but with a story you will never forget. Imagine your friend opens a small burger stand. At first, it's just a table, a grill, and a sign. Business is good. People love the taste. Now your friend wants to expand. He wants a bigger kitchen, more employees, a second branch. But there's a problem. He doesn't have enough money. So instead of borrowing from the bank, he does something different. He says, "I will divide my business into 1,000 small pieces. Each piece represents ownership." He offers those pieces to people. You buy 10 pieces, someone else buys 20, another person buys 100. Now you are not just a customer, you are an owner. That small piece you bought, that is called a stock. A stock is simply a small piece of ownership in a company. When you buy a stock, you own a part of that business. If the business grows, your piece becomes more valuable. If the business struggles, your piece loses value. Simple. Ownership. Now imagine thousands of businesses doing the same thing. Tech companies, food companies, energy companies, healthcare companies, all dividing ownership into small pieces, and millions of people buying and selling those pieces every day. The place, physical or digital, where people buy and sell those ownership pieces, that is the stock market. It's not magic, it's a marketplace, like a giant supermarket. But instead of vegetables and snacks, it sells pieces of companies. Imagine you walk into a supermarket. Prices change based on demand. If everyone suddenly wants mangoes, the price of mangoes goes up. If nobody wants bananas, the price drops. The stock market works the same way. If many people want to buy shares of a company, the price rises. If many people want to sell, the price falls. Price moves based on supply and demand, not emotions of the company, not rumors alone, but human decisions, because humans are emotional. When a company reports strong profits, people feel confident, they buy. Price goes up. When there's bad news, people feel scared, they sell. Price goes down. The stock market is not just numbers, it's psychology. Optimism and fear moving back and forth. Remember the burger stand? Selling ownership allowed your friend to raise money to expand. Big companies do the same thing. Instead of borrowing money and paying interest, they sell ownership shares. That money helps them build new factories, hire more employees, develop new products. The stock market helps companies grow, and it allows everyday people to participate in that growth. There are two main ways. First, price increase. If you buy a stock at $10 and later it becomes $20, you can sell and keep the profit. That's called capital gain. Second, dividends. Some companies share profits with owners. If you own shares, you receive part of the profit regularly. Like the burger stand sharing earnings with you, you get paid for being an owner. Let's go back to the burger story. Imagine news spreads that a new competitor is opening nearby. People panic. They sell their ownership pieces, even if the business is still fine. When fear spreads quickly, prices fall quickly. That's what we call a market crash. But here's something important. The market doesn't crash because it's evil. It crashes because human confidence changes. Confidence up, then price is up. Confidence down, then price is down. If you zoom out over many years, something interesting happens. Despite crashes, despite recessions, despite fear, the overall market has historically grown over long periods. Why? Because businesses innovate. They create value. They solve problems. As long as companies continue producing goods and services people need, the market reflects that growth over time. Short-term chaos, long-term progress, no, that's one of the biggest myths. Today, you can start investing with small amounts. The stock market is simply a bridge. It connects companies who need money with people who want their money to grow. It's participation in economic growth. But let's be honest, the stock market is not guaranteed money. Prices can fall, companies can fail. That's risk. But avoiding it completely has another risk. Inflation. If your money sits still while prices rise, its purchasing power shrinks. The stock market is one way people try to grow money faster than inflation. Imagine a small juice brand. You invest early when it's unknown. Years later, it becomes the biggest juice company in the country. Your ownership piece becomes very valuable. But imagine instead it fails. Your piece becomes worth almost nothing. That's the reality. Ownership comes with both opportunity and uncertainty. The stock market is not a casino, although some people treat it like one. It was created for funding businesses, sharing ownership, growing economies, but emotions turned it into something dramatic. Headlines exaggerate. People overreact. But at its core, it's just a marketplace of ownership. So next time you hear the market is up or the market is crashing, remember this. The stock market is simply millions of people deciding what companies are worth today. It reflects hope. It reflects fear. It reflects human behavior. And if you understand that, you stop being controlled by headlines. You start thinking long term. Because the stock market isn't a monster. It's a mirror, reflecting how humans feel about the future. Let me leave you with one question. If you could own a small piece of the companies shaping the future, would you want to just watch from the outside or participate? Because that is what the stock market truly offers. Ownership, growth, and responsibility. Finally, this channel exists for those who are ready to rise. If that's you, like the video, subscribe, and let this be your daily reminder.